Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. Justin, welcome to the show. Tell me, where are you calling in today?
Indianapolis, Indiana. Been born and raised here my whole life.
That's awesome. Well, like 3 hours away. We're in Chicago here, and it's pretty cold out there. So I'm really happy to have you on the show. You have an amazing story, and many of the listeners are operators. We have some builders, and definitely the story is very interesting. How did you get in development, brand new construction development? How'd you get in over there?
Yeah, so today my portfolio is all just focused on, Class A, market rates, mixed use communities here in Indiana. I'm staying like very just laser focused on that one thing, and it's only building these market rate communities in Indiana. But yeah, I definitely didn't start like that. Like I said, I'm, born and raised in Indianapolis. I went the whole traditional route of, business school, got a finance degree, started working at a bank as a underwriter, as a multifamily underwriter, doing analysis on bridge loans after college. I was taking my couple weeks of vacation and doing the whole 401k thing, and I was kind of just getting burnt out in that life. Started looking for like other ways to have that passive income and build that wealth on the side, because like I was sitting behind my desk as an underwriter and working for the bank as an underwriter. Like you see everything, like you see the borrower's tax returns, them paying $0 in taxes, you see their balance sheets, and I was like, oh, I saw like all this stuff, like all this wealth that these customers were getting, and I knew I wasn't going to get that just sitting behind the desk doing this rest of my life. So, like most people, I got interested in real estate and bought my first rental property on the west side of Indianapolis. Did the whole, rental thing for a couple years, did some fix and flips on the side as well, but eventually wanted to get into apartment investing. I was buying a house from somebody, and at the time I was like a new buyer and new to real estate altogether. I didn't really know what to ask the seller when I was talking to on the porch of this house. But I just asked him, like, why are you looking to sell this house? Ask a question, right? And he said something that was like really interesting to me. He was liquidating all of his houses to go invest in apartment buildings. And he was a guy like, my age, barely just, average, normal looking guy. And I was like, how is this, like normal looking guy going to go out and buy these apartment buildings? And that's like what really kicked it off. After that, I just did a ton of self education, working with mentors, building my brand, finding partners, finding investors. Eventually started the whole process of buying and syndicating value add properties around the Midwest. And about 2 years ago, we transitioned into multifamily development. So today, Goodin Development, like I mentioned, we're building, Class A market rate properties here in Indiana. We just finished a $33 million project in Fishers, Indiana. We're under construction on a $26 million project as we're talking here in January 2026. Then we're launching another one Q2 this coming year, also another Indiana market.
That's awesome. That's interesting. So really no construction background, mostly financial background, like you're really good in spreadsheets and underwriting deals. Any construction background in the past, or no, I'm just, because typically people, that's what we imagine that, if a developer, you have to have extensive construction background, but maybe there was natural.
Yeah, no like direct construction experience, so far, other than when I first got started in the development project. We had no construction or construction management experience directly.
That's awesome. So talk to me why and how you went pretty much straight away to ground up construction. A lot of people end up in value add space for many, many years, and some of them transition to developers. Now, the way you see, let's say like real estate career, 50-year career, that's usually buying houses, renovating houses, then buying apartments, holding apartments, renovating apartments. Then some of them transitioning in other commercial asset classes, office, retail, industrial. And then I think then usually comes in what I see, land development or ground up. And at tail end, I see people then becoming financiers. So it seems like you kind of jumped right away in the development, land development. So let's go back to value add, dressing up apartments, in increasing NOI. and you chose right away going and doing ground up. No, what do you remember? What? Why was that? Was it like a aha moment, or you look at the spreadsheet, something like doesn't make sense? No, what was that?
Yeah, great question. I'd say like the biggest reason on why the transition was necessary, I feel like, I mean, one, it was better for like I think my long-term goals and what I really enjoyed.
Hmm.
I didn't like managing or asset managing C-class properties. I didn't like, dealing with the tenants
I
and the
can relate to
contractors
that.
and all that stuff. Oh yeah. I mean, it's definitely a whole beast on its own after you close a property. I mean, there's, as you know, like there's a lot of hype in this industry about
Hmm.
finding and closing deals, but I mean, man, like the real work happens like after you close a property and you got to deal with that the next, 5 years or so.
Yeah.
So yeah, I mean, I think the value add space is just really time intensive. And number two, I actually think the value add space is extremely competitive, more so than the development space.
Hmm.
As you know, like all these value add properties over the last, 5, 10 years have just become very mainstream. And
Hmm.
that means there's a ton of different buyers all across the country looking at the same particular niche and strategy. And
Yes.
that then drives down spreads and drives down returns because the competition is increasing. So I went like a year and a half without finding really any value add deal to pencil out in my analysis.
Hmm.
And this is just making it difficult to scale, difficult to make a living. So all those things just in, combination, I just felt switching to development was better for a long-term strategy, less competition, and would
Hmm.
help me, scale my business faster. And turns out, since then, like all those three things have been true.
Wow, that's awesome. So your model is you building, stabilizing, and you selling it, or you refinancing and keeping it? What's typical strategy in your on your deals?
I hate saying it depends, but it kind of does depend. But to answer your question, we're primarily looking more towards to sell, like I mentioned in the beginning. But asset management is a whole different beast on its own, and I like being a developer. I want to focus on being a developer, and if I start holding too many properties long term, it just kind of turns into more of an asset management role. So yeah, primarily looking to sell and just focus on actually developing properties.
Yeah, and there is not. What I say. There is nothing wrong about it. There's a lot of preaching going on. You just have to hold until you die. But I've seen a lot of very successful developers who just increase the value and could keep moving on a project. That fits their lifestyle. That's who they are. They just want to increase the value as much as possible and create another project. And some people just really good at holding it and just working with magic compound interest. And I definitely there is magic in compound interest, but there's a lot of magic with people who can create a lot of value very quickly, very good, compared to people who cannot do that, right? So I definitely I want to say that there is no right or wrong in the way I see it right now after 20 years. There is no one way to do other way to do it. Great. And all right, so this is a lot of great insights even for me. What about on a construction site? So, do you have on your team who is what I call the driver in the bus who understands intuitively construction costs, who can walk in the project and kind of, and get a real good understanding, how much it's going to cost before you hire the GC? Do you have someone like that, or how do you, and I think about developer and that one of the skills you must have besides really good instinct, if it's going to be a great project in terms of going to be able to increase that value and have that value and forecast financially, you also have a really good sense on the cost and the construction cost. Do you have that in your team? How do you go about it?
The great thing about that is like the GC we work with, I view them as a real partner in our
Mm-hmm.
deals because their execution like really like translate into our success on the project. So the good thing about our RGC is that we can call them anytime, we can set up meetings with them, we can bounce cost off them and get an idea. If we're looking at a site and we need an idea of cost, they have built so many of this similar product that they do for us. Like they're so experienced, they can usually give us a very good idea of what that's going to cost just by doing some or just by giving them some basic renderings from our architect. We can tell them the unit count and how much commercial or retail is going to be there, just an idea of how much, brick or other amenities, amenities we want in the project. But just giving them like a high level conception view on it, they can usually back into a price that is pretty accurate. And they're also doing other bids for other companies out there, other developers. They're also doing other projects. So, they're living this and doing this every day and have like a real pulse on the market. So yeah, to answer your question, if you ever, need cost or need like second opinion, it's pretty easy. Just get in contact with our GC and get their feedback.
Every week, I read hundreds of commercial real estate articles from across the U.S. and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Perform underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys.
Do you mind sharing any rule of thumbs, like, napkin calculation, how you scope out that the projects are going to be great? For example, now, Ryan, if we're talking about value add deals on industrial, if it's heavy lift, you want to be at roughly 10 cap basis within 2 years on your total cost. So let's say if you're buying something at $50 and the leasing rate is $7, you don't want to spend more than 20. So it's going to be $70 all in if you can lease it within 2 years at 7. So it's kind of, and it just like basically you don't want to go above that. Or let's say if I still build some small residential, not at your scale, like couple 4 flats, and which is, less than $2 million projects. But really, those flats were bought a long time ago. My land kind of conceptually, I don't want to be more than 15-20% all in the land on a total project cost. But that's a small scale. I don't know if you have any like napkin calculations, how much you have to be per unit all in the land, or do you have anyone like when you're scoping before you engage your
I actually don't. I don't have like any sort of calculations on, what I need to pay for land or what, this or that. I'd say like the main metric that I look at, after I've done my analysis and I have my numbers in the model, if I want to see like, does this deal make sense at a high level, I'm looking at what's called the developer spread. So I'm calculating my yield on cost, which is like sort of like my stabilized rate of return against like my total project cost. So let's say that's 8%, just a pure example. And then I'm looking at the market cap rate in that market. So if a market cap rate is let's just say 7%, that's what I think I could sell the property for once it's all leased up, stabilized. This is what I feel confident other Class A properties can sell for in this market. And then I'm taking the difference between my yield on cost and that market cap rate, which equals my developer spread. I like to see a development spread of 1.5%. And if you can find that, even though that's pretty rare nowadays, but that shows me like how much value I'm creating in that deal, or how much like juice is in that deal, is that development spread. So yeah, just taking the difference between my yield on cost and my stabilized market cap rate to see like how much just value is in that deal.
So yield on cost, it would be, you said like 8% would be based on what it costs to build compared to what you're going to sell. It's about 8% of what you're looking at minimum, right?
I'm looking for a minimum of a development spread of 1.5%.
Yeah, but you mentioned something about yield on cost of 8%. So can you walk me through that if you don't mind? How do you calculate that?
So I'm taking my stabilized net operating income. So when the property is, fully leased up, fully stabilized, expenses are normalized, this is my stabilized net operating income number I think it's going to spit out. And then I'm going to divide the NOI by my total project cost. So if it took me $10 million to build it, I'm going to take my NOI divided by $10 million, and that's my stabilized yield based
Cost,
on what
yeah.
exactly.
Yeah, so the way I call it in our operation is that it's cap on our basis, pretty much. It's
Oh, okay.
almost the
Yeah.
same thing. Yeah,
Same
it's
thing. Yeah.
what's going to be
Probably.
our cap on our basis, not the market basis. Yeah, so it's very similar. So let's say we're looking
Yes.
also in value add between two at the minimum spread between basis and market cap on stabilized. Four, it's great, but it never happens anymore.
Yeah.
This is great. A lot of information. Now, another thing, what always interests me in development is finding that additional value you can create through grants, tips, and stuff like that. So let's say in a small development I did to this day is typical those grants and tips are not available. But let's say when I analyze some of the projects, especially in small bay industrial, you can clearly see that there is some other capital involved or grants to make this project, successful, like, tips or some municipality grants. And we were involved in a few projects scoping out right now. So the question to in your developments, do you get those incentives, and how often is and how important it is in that game? In my view, in let's say industrial, it's really important. It's one of the most impossible to do in a lot of those projects if you don't get those.
Totally agree. But yeah, our whole business model is focused on public-private partnerships. So
Mm-hmm.
basically, what that means is like we're just finding ways to partner with the municipality to make this project financially feasible.
Mm-hmm.
This isn't grants or incentives that like go into our pocket, the developer, to make us any more rich. It's purely, like you mentioned, to make that project financially possible, or else it
Yes.
doesn't. The math doesn't math, and the project doesn't happen.
Mm-hmm.
So yes, we've used TIF, we've used other incentives, other kind of resources available from cities and towns on our past projects, and we'll continue doing so. But yes, that's a really like the core center of our business today is how we can partner with these different municipalities to build this extremely nice quality project in areas where it's going to be extremely difficult or like you mentioned impossible for it to pencil out based on the rents and the values in that particular market.
Rents are just short, 20% short. That needs to be to pencil this out. Right.
Exactly.
So you need to bridge the gap with the capital. Uh, Interesting you just said no core, and I had a feeling that's what it is, coming from value add. People don't get it, but I think this is probably one of the most important things of the business when being a developer, to figure it out, all this maze, because I'm pretty sure there's not only three type of incentive, there's probably, I don't know, hundreds or dozens of those incentives could apply, and you have to figure out which works, right? Exactly. Awesome. This is great, man. No, that's a lot of information. So, do you mind sharing? Let's say, what's the time frame of the project? Let's take one of the, you mentioned 30 something $1 million project, from A to Z, from identifying land, entitlements, building and stabilizing it, refinancing and selling. How long is that? Is it 3 years, 5 years? What is that? Do you have like rule of thumbs again? I'm pretty sure there's something can go wrong, and something will go wrong always.
Oh
But
yeah.
you still have some rule of thumbs. What are you aiming for?
Yeah, I'll just take like my most recent one that's under construction right now because it's kind of like still fresh in my mind. It took me from actually going under contract on the land to actually putting shovels in the ground and starting construction 13 months. And depending
Hmm.
on where you're at and what you've heard, I mean, that could be really fast, that could be
Yeah,
really long, but I'm here in Indiana. And that took me 13 months to go through some rezoning, to line up
that was.
incentives, financing. We do syndications and raise capital from investors.
Hmm.
All the above took 13 months to go from under contract to actually starting construction.
Hmm.
This project in Kokomo is, like I mentioned, it's a $26 million project. It's on 3 acres of land. It's 114 units and 3,000 square feet of commercial.
Hmm.
That's going to take us around 14 months to build.
Hmm.
Ish, like between 13, 14 possibly.
So like 2.5.
So we started construction last year. We're about halfway there now. We think we'll be leasing up on this coming August in 2026. It's 114 units, like I mentioned. We think it's going to take another. I mean, hopefully it'll be faster, but 6 to 10 months, maybe even 12 months to lease up 114 units. After that, it might take another, 6 months ish to kind of just stabilize things, stabilize expenses, etc. All in, yeah, we're looking to sell after, 3 years total to get in and out on this one here.
Yeah, a little over a year permits, a little over a year construction, called 6 months to a year to lease up and stabilize and sell. So a little over 3 years, probably 4 years. And these timelines actually apply pretty much the same when I'm looking back at my projects, whether that's 4-unit building seems like, or this is for 140-unit building.
Yeah, kind of similar for me as well. Like our past projects that we've done, the one I'm working on now, it's probably gonna be a similar time horizon, probably longer construction. This one's gonna be a bigger project I'm working on now, but yeah, all pretty similar timelines. To start construction, lease it up, and build it.
And so when the project is taking so long, and we have the raising capital from investors and partners, do you have where you as a developer get paid along the way, or it's still most of the changes at the end at the end? Or do you have any chunks in the beginning acquisition? So do you structure any tranches for yourself, guys? So it's a long
Sure.
time to wait, right?
Yes, it is. Yeah, we do something that's kind of unique. I'm not sure if the other developers do it, but I mean, just purely speaking, like what we do,
Mm-hmm.
we take a development fee and we
Mm-hmm.
split that in 3 different sort of tranches. So I'll take a
Mm-hmm.
third of it up front.
Mm-hmm.
I'll
Acquisition.
take 1/3 of it at construction completion,
Mm-hmm.
and then I'll take the last remaining portion at stabilization.
Mm-hmm.
What's kind of key about that is that 2/3 that I roll in to the development, I let it stay in the project. That 2/3 actually acts as a contingency. So we have a separate contingency in our budget, just like regular project contingency. But let's say like we blew through that contingency, I would then spend the remaining of my development fee that's kept in the project as contingency. So it's sort of like a backup to my already budgeted number 4 contingency. Assuming I don't spend that on contingency, then yes, I would pay it out at construction completion and stabilization. But that's kind of how we break out our fee, plus promote in the equity as well when we go to sell it.
That makes sense. That totally makes total. Well, that was a lot of great information. Thank you very much for shining light to us value add people, which is development is really amazing, and we do some of it, and I know in the future we're gonna be doing more of that as well. Now, do you have any projects that you wanna share, or maybe people wanna reach out to you if you, I don't know, need investors and anything like that? That's the time right now to plug in.
Yeah, thanks, Saul. You can go to goodindevelopment.com/invest. On that page, you can fill out a simple form. And if you want to be notified when we have our next opportunity for you to take a look at, you can just fill out that form and we'll give you an email when we have a new opportunity to invest in.
Do you have anything right now in a contract that you're about to start raising, or not yet?
Yeah, working on one right now. It's it's in the pipeline. It's getting launched soon. So yeah, it's
Nice.
coming.
All right. Yeah, I'll put my email over there too. I would like to be pitched.
Yeah, thank you.
All right. Thank you very much, Justin. That was really great. Hope to I hope to walk one of those projects at some point. And see how that's going, and to do another show at some time soon.
Awesome. That'd be great. Thank you.
Awesome. Thank you. Thank you. Thank you.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.